Hello students, welcome to the lecture series of corporate accounting. Under corporate accounting, we shall discuss unit 3rd, and under unit 3rd, we will highlight our discussion on the valuation of goodwill and its part 5th. Under two previous lectures, we have learned about the factors affecting the valuation of goodwill and also highlighted certain methods which are being employed to value the goodwill. We have learned bit about them in a short introduction in our previous lecture. Now we will take up each of these methods and learn about them in detail. So the objective of today's lecture is to understand valuation of goodwill under super profit method, sliding scale method, annuity method, and we shall also cover up the practical aspect of each of the methods of valuation of goodwill. So, under methods of valuation of goodwill, our first topic of discussion is super profit method, and under super profit method, the first method which is to be applied is number of years purchased. So, first of all, let us understand the super profit method. On the basis of average profits and normal profits, excess of the average profit over normal profit, which is generally referred to as super profit, is calculated as under. That is, super profit is equal to average profit minus normal profit. We have discussed the calculation of normal profit, which is one of the important features of valuation of goodwill in our previous lecture. So, we will use that normal profit and we will subtract it from average profits so that we can ascertain the super profit. Normal profit is computed when we apply the normal rate of return into the average capital employed, and the entire discussion is being done to compute the normal profit or normal returns on the capital so employed in our previous lecture. So, we will escape that part to compute normal profit and use the figure as given to us, and in case the figure is not given, we will go step by step. First computation would be of normal profits, then average profits, and the difference of the two is to be computed as super profits. If super profit figure is positive, the value of the goodwill may be calculated by using any of the methods discussed in this section. So, this is the basic test to apply the super profit methods, that the super profit figure should come positive. That means average profits should be more than the normal profits which a entrepreneur is expected to earn, and whatever is excess of the normal profit which is required to be earned to sustain in the business is known as super profits. Now, another dimension of super profit method is the computation of the goodwill using number of years purchased method. So, under this method, it is assumed that super profits will not continue for an indefinite period of time. That means there is a definite period or number of years for which we can earn the super profits. Continuity of super profit depends upon variety of complex factors such as trend of profit, government policies, ruling rate of interest, technological changes, and many more. So, the super profit is not a peculiar or a regular feature of the business entity. The super profits can be earned on a number of years depending upon the factors affecting the business of the entrepreneur. They can be external factors as well as internal factors. Therefore, without going into weightage of these complex factors, an appropriate number is generally suggested, which is called number of years purchased. So, here what we are going to do is that we will fix up the numbers, say 4 years, 3 years, and on the basis of such numbers, we are going to evaluate our goodwill on the basis of super profits method employing the number of years purchased method. So, how we will ascertain the value of goodwill? We will draft a formula and we will learn how to compute value of goodwill using this formula. The formula is goodwill is calculated as follows: goodwill is equal to super profit into number of years. So, here what we have to do is that Firstly, we will have the normal profits, then we will be having the average profits. We will find out the difference of average profits and normal profits and certain super profits. Now these super profits are to be multiplied by the number of years purchased, which are being given in the form of the information, and then we are able to ascertain the value of goodwill. So this procedure is to be applied rationally and step by step to ascertain the value of goodwill. Let us take up an example. With the help of figures, the scenario will be much clearer to the candidates. So here the average profits are rupees 2 lakh and the normal profit is 1,80,000. In our previous lecture, when we have ascertained the normal profit, the same figure of 1,80,000 have been computed. So in the continuity of that example only, we are taking up this further example so that it can be learned in sequence and it can be helpful to the students to analyze the entire mechanism of calculation in a much precise manner. So here the question says to us that calculate the value of goodwill based on 4 years purchase of super profit. So the number of years to be taken are 4 years. So first of all, what we are going to do is that our calculation in respect of average profits and normal profits are being done. So we will go for the calculation of super profits first. Super profit is equal to average profit minus normal profit, that is 2 lakh minus 1,80,000. So our super profits are rupees 20,000. Now the next step is the valuation of the goodwill on the basis of number of years. So here goodwill is equal to super profits into number of years. It will be 20,000, which we have computed right now, and the number of years are given to us as 4. So the value of the goodwill will be 80,000 rupees. Now this is a method which is known as number of years purchase method under super profits method. A further modification is being done and a variant of this super profit method is being evolved. Let us understand this variant of valuation of goodwill under the super profit method, and it is known as sliding scale method. Again, it is also based on number of years purchased, but it is a variant of the super profits method so computed. Let us understand what's the difference between the two. Simple number of years purchase method is based on the implicit assumption that the amount of super profit per annum remains same for fixed number of years, and after that super profit would disappear. As against this, sliding scale method is based on a more realistic assumption that the amount of super profit per annum would decrease every year, and after a fixed period of time super profit would disappear. So the basic difference between simple number of years and that of the sliding scale method is that under simple number of years, after the particular time period being lapsed off, what happens that the super profit is totally vanished, while under sliding method, or what we say that sliding scale method, what happens that the profits or the super profit is gradually decreasing, and for a particular period it can be up to certain amount, then for the next years it can be for certain amounts. So it is more realistic in nature, so its calculation will also vary. Let us take up a practical example or a simple examples with the figures so that we can understand what do we precisely mean by a sliding scale method. It is expected that super profit for 4 years would be rupees 7,000, 5,000, 2,000 and 1,000 respectively. It is expressed in terms of sliding scale as under. The amounts of the super profits are being given under column 1, and in column 2 number of years for which it would continue. So here rupees 1,000 would continue for 4 years. Again the next 1,000 would continue for 3 years. 3,000 would continue for 2 years, and the 2,000 would continue for 1 year. So this 7,000 super profit would be certain or continue in such fashion. So what we are going to do is that as number of years for which a particular amount of profit would continue is decreasing, it is known as sliding scale method. The goodwill is computed by aggregating the product of amount column and the scale column as under. So we will write super profits and the number of years for which it is being continued, and their multiplication will give us the amount of the goodwill, As in the first case, it is 1000 into 4, 4000, then 1000 into 3, 3000, then 3000 into 2, 6000, 2000 into 1, 2000, and aggregating them, we are getting the value of goodwill as 15,000. So, this is one of the important methods to ascertain value of goodwill under super profits method, where a variant of the super profit method known as sliding scale method is being used. Now, moving ahead, we will learn another method which is known as annuity method. So, under annuity method, again we have to do the valuation of goodwill, and under it, what is the scenario being given? Let us highlight it. It is a variant of number of years purchase method to make a concise and comparable value of goodwill in future. Present value of super profit is computed to determine the value of goodwill. Expected interest rate should be used to discount future super profits. So, here there is a difference in the calculations. The super profits which are being used, they are being taken at the present value. So, what we are doing is that we are discounting the super profits, so computed with the appropriate expected interest rates and ascertain its present value. Once we are with the present value of the super profits, we can go for the calculation of goodwill. So, here it is a improvement over the super profits method and sliding methods, because it is taking into consideration the present value of the super profits. So, let us understand the calculation mechanism of goodwill under annuity method. Firstly, present value of super profits is to be ascertained. How we are going to do this? That relevant annuity table with reference to number of years is taken. Then out of it, expected rate of return is taken from the annuity tables. Then what we are going to do is present value of super profits is to be ascertained, and value of the goodwill is ascertained using this formula, super profits per annum into annuity value. So, this is the method to be employed to compute the annuities method. This is the method to be employed to compute valuation of goodwill, where present value of the super profits are being taken into consideration. Now, let us compare the three methods. Under all the three methods, there is a assumption or an underlying principle that super profit will continue for a definite period of time. That means the super profits will not be indefinite, or they will not continue as ongoing business continues. That means business might be under going concern entity, but the profits are not to be continued in that fashion or in that trend. So, super profits are obviously above the normal profits, and the difference of the average profit and normal profit, which is assumed to be positive, and such situation may not always exist in the business. So, what happens, that a very realistic approach is being used for valuation of goodwill based on super profits method, and among it, let us highlight the difference among all the three methods which we have learned right now. Number of years purchased, it takes the definite period of the number of years to be purchased, which is being multiplied by the super profits to value the goodwill. Under sliding scale method, more realistically, we will do the calculation that up to what number of years such profit will continue, and we will product the years with the super profit and find out the value of the goodwill aggregating all the products. Then under annuity method, again it's for the improvement or a variant of the number of years method, where the present value of the super profits are being computed, so that it will be more comparable with the valuation of the goodwill. Now, the next method, which is a different method from that of the super profits method, is that of the capitalization of super profit method. Capitalization of the super profit method means that we are taking up the rates which is to be used so that we can capitalize the super profits. Now, how to capitalize the super profit? It can be capitalized using a formula which is 100 divided by normal rate of return into super profit. Again, the underlying calculations which we have learned as the very basics of valuation of goodwill, that is normal rate of return, is to be used. Again, super profits would be computed taking the differences of average profits and normal profits, and when we go for capitalization of such profits, we will get the value of goodwill as 100 divided by such rate, which is normal rate of return being given into super profits, and value of goodwill can be ascertained. Then what happens that capitalization of value of the business can be done. Under it, what happens that average profits may be capitalized on the basis of normal rate of return to calculate the value of business. When we are going to value the business, rather than going for super profits, what we are going to capitalize is the average profit. So here there is a change in the formula. First of all, capitalized value of the business are being ascertained, and the difference of the capitalized value and that of the investment would be the value of goodwill. So when we go for the another method or alternative method to compute the value of goodwill on the basis of capitalization, there are two steps to be followed. Firstly, capitalized business value is to be ascertained, and secondly, the differences of the capital employed or the investment with such value is to be ascertained, and which shall form the amount of goodwill. So let us highlight the formulas being given. Under step 1, capitalized value of business would be ascertained as 100 divided by normal rate of return into average profits. Then we are with the capitalized value of business from this formula. The second formula to be applied is goodwill is equal to capitalized value of business minus investments so made or the capital employed. So the basic mechanism of computation of the goodwill using the capitalization of super profits method is clear to us. We can take up certain figures so that we can understand it in an elaborated manner. Suppose the normal rate of return is 10% and the average profits earned are 50,000. So what happens that 100 divided by 10 into 50,000 will give us the value of the business or the capitalized value of the business as 5 lakh rupees. And if our investments or capital employed is 4 lakh 50,000, 5 lakh minus 4 lakh 50,000 will give us the value of the goodwill, and that will amount to 50,000. So 50,000 should be computed when we follow these two steps, that is valuation of the business and the difference of the capitalized value of business with that of the investment so made. Now we are ending up our lecture of today. Let us summarize what we have learned in today's lecture. Under today's lecture, we have learned about various methods for computation of valuation of goodwill. Among it, first one was super profits method. First of all, we have computed the super profits, which is the difference of average profits and the normal profit being computed. Normal profit is computed by applying the normal rate of return to the investments or average capital employed. So under step 1, normal profits are to be ascertained, then average profits are to be known and ascertained. After that, difference of the two is to be taken to find out the super profits. Now the super profits can be used for the valuation of goodwill on the basis of number of years purchased, and number of years purchased can be determined by the management and by taking into consideration the past trends. And there is an assumption be followed when we go for the valuation of goodwill on the basis of super profits is that the super profits would not continue for an indefinite period of time. That means after a period of time they will vanish or comes to an end. So the sliding scale method is being adapted to find more realistic value of the goodwill, where the value of the goodwill is to be analyzed taking into consideration the period for which the super profits would continue, and we will find out the product of the number of years for which the profit would continue, and we will add up all the products so that we can ascertain value of goodwill under sliding scale method. Then we have made a further development or a variant of the number of years purchase method, where annuity method is being used, where the present value of these super profits are being ascertained to make the value of goodwill comparable with the futures, and We have also learned how to find out the capitalized value of goodwill by capitalizing super profits, and when we are taking up average profits, how we are going to find out the value of the goodwill. That means under step 1 we will capitalize the value of business and find the difference between the capitalized value of business and the investment to ascertain the value of goodwill. With this, we are ending up our lecture of today. Hopefully, all the methods are being cleared to the candidates. Thank you.